that you said?
Question number 1. Below is a trial balance for Kwashamu Kwenu Enterprises for the year ended 31st December 2017. Number 1. The purchases / sales. So what it means is that the sales are these, then the purchases are these. You're following, right?
Oh, okay.
Yes, that's what this means. That's how you look at that. Then the premises, you know, the premises is basically more like land. Land is a non-current what? Asset, right?
Mm.
Land is a non-current asset or a fixed asset. Okay, let's start from the sales and the purchases. The sales and purchases go in the trading account, isn't it?
Yes.
Yes. Then when you talk about the premises, they are assets, so they go in the balance sheet, isn't it?
Yes.
Plant and machinery is a non-current asset. Fixtures and fittings in the balance sheet. Motor vehicles in the balance sheet still, right?
Mm.
You're following, eh? Then when you talk about plant and machinery accumulated depreciation, we use the depreciation.
Fixtures and fittings are assets?
Yes, they are fixed assets actually.
Okay.
Yeah. Then plant and machinery depreciation. This depreciation, accumulated depreciation, we'll consider it in the balance sheet. Okay. Well, I will show you how we consider it. Motor vehicles and like all these. Okay. Then inventory 1st January 2017. What do you think of this inventory? Opening inventory or closing inventory?
It's opening inventory.
Yeah, you've seen, this is what I was trying to explain to you. The year is ending, the trial balance is ending on 1st December 2017. Then you are given the inventory for 1st January 2017. This is the opening. It shall not be labeled as opening. Just check the dates.
Mm-hmm.
She has heard Wasa. You can continue.
So inventory goes to the profit and loss.
Yes. The inventory. Then you go to returns. Check. There are 2 returns here. There is some return that is on the debit and the one that is on the credit. Okay. So which one is the return inward? There is the return inward and the return outward. The return inward is a receipt to us, right? Return inward when people bring back our things. So it's a debit entry. So on the debit you have the returns what? Inward, right? Then on the credit you have the returns what? Outward. This is the returns outward. You know the returns inward now, I explained already. You make sales, then they return your sales. Then returns outward is when you as a business you go, you purchase. After purchasing some goods, you basically sell, you return those things that you had purchased. Okay, probably they don't meet your standard or for some whatever reason. Okay, or maybe quality is not, you get, right? So what will happen is that you return those things to your suppliers. You say, Baba, here are your things. Okay, here are your things. So when you return the purchases, that is called the returns outward. Outward of what? Of the business. Is that fair?
Yes, sir. Fair enough.
Okay. Carriage inward. Carriage inward is basically the cost that you incur when you are bringing the things into the business. So carriage inward is the cost, actually. It's a cost of goods or the cost of sales. Because when you're bringing those things, when you're ordering them, there's that cost you incur as you're trying to bring them into the business, yeah? So that cost, it is called the carriage inward. Clear? Carriage outward. Carriage outward is when you are taking the things outside. When you're selling, when you're taking the things outside the business now, you're selling as well. There are some costs that you incur. Because when you're making sales, especially in standardized businesses, you find that you have to be responsible of making sure that the goods, the sales are made. There are some costs that you incur. That is called the carriage outward. It could include loading costs, loading expenses. Sorry, those are expenses. Carriage outward is an expense. Carriage inward is a cost. Okay. With the carriage outward, it's basically an expense. Yeah. It is related to the sales, not to the cost of the sales.
So carriage
basically,
outwards is an expense.
It's an expense, yes. That you should understand that the position of this is actually an expense. So it goes, where does it go? So we said returns inward, returns outward, all these opening inventory, they go in the trading accounts, right?
Mm.
Then carriage inward also in the trading account, but carriage outward in the profit and loss account because it's an expense, right?
Mm.
Wages, rent, lighting and heating, the discount allowed, not the discount received. Okay? The discount that you allow, it goes as an expense if you allow a discount. But this time around, you have the discount that has been received and the discount that has been allowed. Okay? One thing that you should understand here now is that you have to understand which one is the discount received and which one is the discount allowed. Right?
Mm.
From the behavior of the cash flow, you will understand that when you allow a discount, the discount allowed from the three-column cash book, pay attention, just visualize the three-column cash book. The discount allowed is recorded on the debit side, isn't it? If you allow
Yes.
a discount, you record that discount allowed on the debit side, right? Because you record it on the debit side, you allow it when people pay. Those people who owe you as a business, they are paying, right? As they are making payment there and then you receive those payments, then you allow the discount. So you record on the debit side. Then the discount received is always on the credit side of the cash. Why should it be on the credit side? It's an expense because the discount received, the discount allowed is on the debit, but the discount received is on the credit. Okay? Yeah, let me rephrase that so that you understand. The discount received, it is on the credit. Why should it be on a credit? Because from the cash book set up, the three-column cash book, you know that you receive a discount when you make payments, isn't it? And all the payments that you make are on the credit side. So you make payments on the credit side, then you receive some discount. Okay, so whatever you receive is what is called the discount received. It's on the credit side of the cash flow. Is that okay?
But it's an income because when you receive the discount,
yes, that is an income. It's not an expense, but the discount allowed is the one that is an expense. So you should understand.
Discount allowed is an expense, and it's found on the debit side.
Yes, of the trial balance. Yeah. Clear?
Clear, sir.
Okay. Telephone, you know that those are expenses. Printing and stationery expenses. Bad debt. Bad debt is same as a recovery date, okay? A recovery date. Motor expenses. Are you able to follow? Motor expenses.
So what's the difference between motor expenses and motor vehicles at cost?
Motor vehicles at cost is, oh, by the way, at cost simply means this is an asset that you bought, a long-term asset, the one that can stay for more than 12 months or for more than 1 year if you may like. then you bought it at how much? At cost, this is the value, how much you bought it when you bought it as a when you brought it into the business. That's what we say at cost. So plant machinery at cost simply means when they were building this plant and the machine, they spent that much when they were building. That's the value of it from the inception. Remember, you will see that these costs will be reduced due to depreciation with time. But always we calculate depreciation considering the cost. We remove it from the total cost, how much you spent or how much you valued it at first before it depreciates. That's what will help us to know how much value has been lost or from the non-current asset. Is that fair?
Yes, sir.
Yeah. If that is fair, then we can move on to other elements. The one that I've given you is loaded today. It's loaded with a lot of things. You've seen, right? Yeah. Repairs, those are expenses, right? Advertising expenses, insurance expense, accounting fees expense, right?
Yes.
Loan interest an expense, bank interest expense, allowance for irrecoverable debts, which is same as allowance for receivables.
What bank interest and expense?
Sorry? Yes,
Why
it's an
is
expense. You are paying, like you are paying that. It's a payment. Now the bank interest. Oh, I see. From where the point of standing where you are. It's not really. We're not talking about the interest like that one where you deposit the money in a fixed chan so that it earns that interest. That's not what we are talking. We look at it as the interest where you pay. Okay, you pay for those charges. They're more like bank charges, if you may like. Yes, there's those charges. Then the allowance for irrecoverable debts, bad debt, isn't it? This is the allowance for receivables as well. It's the other name, right? Allowance for irrecoverable debt or allowance for receivables or provision for bad debt. I'm mentioning all the three names so that you can be fine. Allowance for irrecoverable debt, it is same as the allowance for receivables. It is also same as the provision for bad debt, right? All the three, they mean the same. Trade receivables, these are people who owe you. Yes, this one is an expense, profit and loss. Trade receivables, the people who owe you. In other accounts, you find them as debtors, okay, the debtors. Cash at bank, cash at hand. The cash at hand, cash at bank, and trade receivable, these are current assets, all right? They are assets, but current assets. Then trade payables, those are people you owe. Yeah, the accounts that you owe as a business. The suppliers to whom you owe money, okay? Those that supply to you on credits. You're following, right?
Yes, sir.
Trade payables, okay? So that simply means all these, they go in the what? In the balance sheet, okay? The loan itself, the long-term loan is a non-current asset. Drawings, they go under capital, that is in the balance sheet. Similarly, capital goes in the what? In the balance sheet. Is that okay?
Yes.
If that is okay, then this is what happens. There are following notes to make now. Depreciation is provided as follows. You have to calculate for depreciation. Now you pay attention when it comes to depreciation. I said under expenses, there is a part where you write the depreciation, right? But the depreciation you're writing is not this depreciation. It's not this accumulated depreciation. You don't write this accumulated depreciation. This one is a depreciation from the previous periods, if you might like. Like from the time the asset was bought, right? Up to the 1st January. How much value was lost by the what? Had been lost by these machines or these assets. The total depreciation, the total value that the non-current assets had lost from the time they were bought up to now is what is called the accumulated depreciation. All right? Up to January. I'm saying up to January. Then you need the depreciation that has occurred now from January up to what? Up to December. Isn't it? That depreciation is not there on the trial balance. Because the trial balance, this trial balance is just capturing the things that happened previously. You understand? Previously. So for depreciation, is just showing us the depreciation that occurred previously. It's not showing us the depreciation that has occurred in this new period. So you should learn that in the profit and loss account, you put the depreciation that has occurred in this period under concern. And how do you calculate that depreciation? You use now the notes that are here down. Okay? These are the notes that you use. They're saying, number one, the plant and machinery, it is on 25% straight line basis. That's a depreciation. So how do you do straight line? Look at this. You just say percentage times the costs. That's how you get the depreciation. You're following, eh? Percentage times the cost. So in that case, you say 0.25, which is 25%, eh? Times the cost of plant and machinery. That's the straight line method, okay? Of calculating depreciation. Plant and machinery, the cost is what? 145,750, right? 145,750. You can see it, isn't it? Or the cost, sorry, no, that's accumulated depreciation. The cost is for plant and machinery. The cost is so how much is this? It is yes, it's 130. It is 430, right? Are you able to see?
For what?
Check.
Plant and machinery.
Yes, cost for plant and machinery. It's 430, right?
Oh, okay.
Yeah, it's 430. So you do 25% of 430, like 0.25 times 25 what? Like times how much is this? Times 430,000. And what do you get as the depreciation?
100. How do you say this? 107,500.
107,500. This is the depreciation that has occurred, or this is the value that the plant and machinery have lost in this new period. Okay? At 25%. That's how you do it. Straight line method is very easy. It's just the percent times the cost of that particular asset, right? Even you can even do the straight line for fixtures, for motor vehicles, as long as you're given the percentages, you do that. Is straight, just that, multiply by that. That's the depreciation. So in the profit and loss account under depreciation, you will put this figure. Because under the depreciation that you put in the profit and loss account is only the depreciation that has occurred in the new period. Is that okay?
Yes.
Okay.
So in writing, now, I ignore the other depreciation, this one, and write
these accumulated.
And write the one that I calculate.
Yes, I will show you where we apply this one. It's not now.
Okay.
Yes, you use it when you are using the reducing balance method. If you are using the reducing balance method, that's where you use accumulated depreciation. And in the balance sheet, you need accumulated depreciation. You understand, right?
Yes, sir.
You're following?
Mm.
If you are following, well and good. Then fixtures and fittings, 10% straight line basis. Meaning all of them were just a straight line, straight line. Obviously,
Mm.
you have known, right?
Mm.
Isn't it's just 10%, which is 0.1 times the cost for fixtures and motor vehicles. Now, my question is, in case they say 10%, let's say 25% using reducing balance method for plant and machinery, see how different the depreciation will look like. I want to show you how to do reducing balance method. In case in an exam you find the reducing balance. You're following?
Yes, sir.
25% now on a reducing balance method basis. This is how it shall be. Reducing balance method, it will be the depreciation shall be equal to the net book value times the percent. Okay. What is net book value? Net book value is costs minus accumulated depreciation. Okay. Accumulated depreciation. All right. That is equal to net book value. You're following, right?
Mm.
How do you get net book value? You say cost minus accumulated depreciation for that material. You get the net book value. Then net book value times the percent is what gives you what? Depreciation. Did you get it?
Sir, you said net book value is
Net book
equals to
value is the cost. Like these assets, they have costs. They are given at cost. Yes, the cost, how much you bought that asset, minus the accumulated depreciation is there in the trial balance. Then what you get is the net book value. So that net book value you get now times that percent is what gives you the reducing balance depreciation. Got it?
Mm. Yes, sir.
Yes. So in this respect of ours, for fixtures, for plant machinery, you have the cost, which is what? 430, right? You want the net book value. 430,000 minus the accumulated depreciation for plant and machinery is what? 145,750. You can see it? This one. This is the accumulated depreciation now.
Mm.
What is the net book value?
Mm.
What is the net book value?
I'm just calculating.
430,000 minus 145,750.
We have 284,000, 284,250.
So 284,250. This is the net book value. So times the percent now, which is 25%, 0.25. Right? What do you get? That will be your depreciation. What do you get?
71,062.5.
71,000.
71,062.5.
0.
62.5.
0.5. Okay. So 710,000, 710.
It's 71.5.
71,062 kwacha 15 way. This is the depreciation. You have seen the logic, right?
Yes.
So you do the same for these other assets, as long as it is said to be using balance. You do the same. That's how you get, this is the depreciation now that you write in the profit and loss account, right?
Yes,
Under
sir.
depreciation. Yes. So you have known how to calculate both the straight line method of depreciation and reducing balance method, isn't it?
Yes, sir.
If you have learned that, the other adjustment now, I'm with the adjustments that you need to make. Always before you start writing the profit and loss account, you should check, you should read first the notes. You see if you are told there are adjustments that you have to make which go in the profit and which go in the trading account. You understand? Huh? Because some adjustments that we have, they go straight in the trading account. You get?
Mm.
There are some adjustments that we make in the trading account. Okay? Whereby maybe you are calculating, you just realize that there is some what? There is some discount allowed, or sorry, discount received. Those are other incomes. Then you find that in the notes you'd have already calculated because you didn't see it. Okay? Or maybe there are some adjustment to purchases. They will say, no, purchases reduced by this much. You understand, right? Then you didn't see that. So in short, first you see the note, read the notes, see which note affects which one, and then make the adjustment necessary. Now, the other critical adjustment that you have to make is for the provision or allowance for receivables. The allowance for recoverable debt. This one is very crucial and you pay attention because this one, it will help you to know whether the figure that you find the allowance for receivable, whether it is going in the expenses or it is going in under other income. You have to know that. How do you do it? You have to calculate. The first one says a shop accountant feels that 10% allowance for recoverable debt should be made. So it's 10%. 10% of recoverable debt for recoverable debt should be what? Should be allowed. So this 10% is actually 10% of receivables because it is from receivables where we get recoverable debts. Is that okay? So you do 10%, which is 0.10 times, you check the receivables, total trade receivables. You multiply. Okay, don't multiply with the recoverable debt here. You understand the mistake? There is a recoverable debt here in the. You start maybe thinking the 10% should multiply with the recoverable debt. No. The 10% is multiplied on the, it's an allowance on the receivables. So you should multiply it with our receivables. And where are the receivables? Or in the next slide. Here are our receivables. Have you seen our receivables? Trade receivables, right?
Yes.
They are here. So you say 0.10 times 397 2,260. When you multiply that, this is the allowance for irrecoverable debt. How much is it?
This is 39,726.
26. Like this? There's no zero somewhere? Okay. 39,726. So this is the allowance for irrecoverable debt. Now, that has occurred in this period. So what you do, you subtract that one, the irrecoverable debt, like the allowance for recoverable debt that you have in the what? In the trial balance. You get? There is some allowance for recoverable debt which is there in the trial balance. Are you able to see it? It is 30,000, right?
Yes.
It's here. It's here on top. There is this recoverable. So you should do minus 30,000 like that. Pay attention in how you are subtracting. Don't do the opposite. Don't subtract this, what we have calculated from that. You will miss it. It is this amount that should be subtracted from this, from what you have calculated, okay?
Mm.
When you subtract, you will understand that the answer that you're going to find here in this case is positive, right? It's 9 something, isn't it? It's 9726, right?
Just yes.
Yeah.
Yeah.
This is now, when you check this, this is called an increase in allowance for irrecoverable debt. Why is it called an increase? It's because it's a positive. You understand? If it is a positive, when you subtract this, the allowance for irrecoverable debt from the trial balance, from this one you have calculated, once you subtract, you find the answer is positive. Just know that it is a what? It's an increase in what? In allowance for irrecoverable debt. If it is an increase in allowance for irrecoverable debt, please, you should add it under expenses. It's an expense. The increase in allowance for irrecoverable debt is an expense because it is an increase in doubt. Okay, you are doubting irrecoverable debt. Allowance for irrecoverable debt is some percentage of doubt that you have on your people, on your debtors, right? Like you're doubting them by some percentage that they'll pay you. They will pay us. Yeah. Okay. How much percentage are we doubting? The percentage of doubt is this much. That is the percentage you are talking about. So if it increases, then that is an expense to us. Okay. Our worry, our doubt increases, is an expense. But if it is a negative, it means it's a reduction. So a reduction in allowance for receivable, it should be added under income as a reduction in other words, in allowance for irrecoverable debt. This same amount, if it were negative, it would have been added under what? Other incomes as a positive sign now. Don't take it with a negative. This negative sign is just there to speak to us whether it's an increase or a decrease. Kwasila. But when you are writing, write it as a positive number always. You got it?
Yes.
If you have gotten this, we are okay. So under other incomes, you should always look for allowance for receivables. First, check first Kuma notes. What happened to allowance for receivables? Because you might go up to expenses, just thinking no allowance for receivables are expenses you get. Then you realize that what will happen is that you will realize that the allowance for receivables have come in the under other incomes, meaning they'll come back again to the trading account. You get, if it is a reduction. So you have to assess first. Okay. That is clear, Basa. We have 8. The following amount had not been paid for. Okay. The amount, a ZESCO bill amounting to that much for the shop for the year that had just been received. So the cash book shows a payment 3,750 to date December. Are you following? There is a bill that is amounting to 6,250 for the shop or the year ended the 1st December. So there is this bill, an outstanding bill. So the cash book shows a payment of that to date. So in short, this out of this bill, the cash book is just showing that we paid only that, right? So there is a difference. There is some part which has not been paid already. Yeah? There is some part that has not been paid already. So that part is called the accrued expenses. These are like accrued expenses, right? Accrued expenses should be added to the respective expenses. So you go under power. whether you see lighting or power, you will add that much, which is the difference of that, as accrued expense. You got it? Hello? For accrued expenses, you add them. Like there are expenses whereby you have incurred them and you are supposed to pay, but you haven't just paid. Okay? You haven't paid, but you're supposed to pay. You can have accrued salaries. Accrued salaries simply mean you owe your workers and you are supposed to pay. So you should add that to salaries. You remember salaries are expenses, right? So under expenses from salaries, but you should also add the accrued expenses. You got that?
Yes.
The following telephone bills due had not been provided for month bill. So there is again telephone outstanding bill of 625. You have not yet paid again. So those are accrued. Under telephone there, you saw where there was some expense under telephone, right? Should add that again so that the expenses can go for telephones. Okay? So you just anyway, just make these shorter. Just insurance costs are 562.5 per month. So those are insurance costs anyway. You add them under insurance costs, right? You add them. Closing inventory, you are given the closing inventory. You know where you put the closing inventory, isn't it? The closing inventory is that you write. And the closing inventory of stationery at 31st December amounted to that. So this is the closing inventory again that you add. So because when you're talking about closing inventory, you're just consolidating the closing inventory. Okay. We are consolidating, we are adding everything. Yeah. Then now, can you prepare the, what is this? The profit and loss account and the balance sheet. So it is that, just that. Then there is also a solution. It's a solution and provided. I was just trying to explain much so that you understand the solution. I will send this with a solution itself. Yeah, even a hard copy, a soft copy of this. So as usual, you start with sales minus sales what? Return. You get, what do you get? The net sales, right? From the net sales, you have cost of good, you add the opening inventory. You see that, right?
Yes.
Yeah, opening inventory. From opening inventory, you add the purchases, you have that. Then you list purchases return, right? Which is same as returns outward.
Or purchases return is the same as return outwards.
Yes, returns outward. What you purchase, then you return.
Okay.
Carriage inward, I say it is a cost you add here. It is usually added. You add the carriage inward, have that. Then you let's see the drawings, the goods withdrawn for personal use. Should pay attention to the question. When you find that it is written that the drawings are, the goods are withdrawn for personal use. Once you withdraw a good, for example, a computer for the business or anything, that one should be subtracted immediately here in the trading account. So the goods withdrawn for personal use should be subtracted, okay? So that you can have the total inventory available. And then you list the closing what? Inventory. What you will remain with now is the cost of the sales. Now, this is the total cost of sales. All these adjustments that we are making, we're accumulating the cost of sales. So the cost of sales is subtracted from the sales to give you the gross what? Profit. You see now? You have the gross profit. Yes. When you subtract this. Yeah. Then you add the other income, discount what? Received. You've seen that? Discount received. I want to remind you some. Discount received. You've seen it. 60,000 and 60. 60,000 and 60. Discount received.
Yes.
Okay. So the discount received. You've seen it. Have you seen that it is on the credit side?
18,940.
It is on the credit. That is the discount received. I was just validating what I told you so that you understand. Then from there, discount received is an income you add. The total income is that now. Then you less expenses because all these things that we had are expenses. Carriage outward is an expense. I'm validating that now. You've seen that, right? Then wages are that, rent is that. Now rent, with rent there is an accrued rent. There is an accrued rent. Like there was some remaining balance of rent. So you add that. Total rent charges is that. Head and lighting plus accrued bills, yeah, electricity. Remember that one I told you? Yes. Yes, you add that, you get that. Then the discount allowed, you've seen it now where it comes. It's an expense. Telephone, you also add accrued telephone. I mentioned about telephone accrued, right? See here. You add that. Printing, stationery is that. Then you less inventory of stationery. Because for stationery, they didn't use everything. They had, yes, there is some inventory that remains. You understand that is stationery. So you should less that. You're following, right?
Yes.
Yes, under printing and stationery, we had some inventory that had remained in under adjustment. There was that adjustment that you should needed to consider, and you have considered. Recoverable debt is an expense, motor expenses, repairs, advertising, all those are expenses. Insurance, then there is a prepaid insurance. Okay, you less prepaid insurance. There is that prepaid insurance. Accountants fees are expenses, loan are expenses, and the bank interest. You've seen, I'm validating the point that I told you that the bank interest is what? It's an expense. That's why. Yeah. Depreciation, you've seen now. Those depreciation we are calculating, we just calculated the first one on the straight line. But since all of them were being calculated on a straight line, this is what. Me, I just did the first one. Then the second one, I wanted to show you how to do reducing balance in case you find reducing balance. You've seen the increase in allowance for recoverable debt. That figure we calculated, it's here now as an X. Yeah. Then all you have, all you remain with is the total expenses there. That should be subtracted from total income to give you the net profit. Okay? The net profit is that.
So
you got
I can't
it?
see your screen.
Can't see my screen. I think it's just I'm sharing it. You can try to quickly log out and log in.
Did I press anywhere?
Hello?
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 Sir, are you there?
Yes, I'm there. You're unable to see the screen. That's why I said try to log out, then you log in again.
Okay. Can see. Hello?
You're able to see now? Okay, it's fine. We go to the balance sheet, which is same as the statement of financial position. So with the balance sheet, we start with the non-current assets, which are fixed assets. So if you fix asset, what you do from the cost, you should remove accumulated depreciation. Now I want to comment on accumulated depreciation. Under accumulated depreciation, it is the depreciation, that one you find in the trial balance as accumulated depreciation plus the depreciation you calculated. You understand, eh? Because the depreciation you calculated, it was just for this period now. Then the accumulated depreciation in the trial balance was for the previous period. You add the two depreciations, okay, to have that depreciation. Check that the premises don't have depreciation, right? That's why they are just here. There was nothing to be subtracted. So this is what happens when I say you consider the accumulated depreciation in the balance sheet. You add both the depreciation in the profit and loss plus the one in the trial balance. Then you subtract it from the cost, you get the net book values. So these net book values should be summed together. You have this total non-current asset, right? What you get now is the total non-current assets. We have the total non-current assets. Then we add the current assets. Under current assets, we have inventory. From the inventory is a non-current asset. The closing inventory. Yeah, maybe you get it like that. Then trade receivables. Trade receivables. From the trade receivables, you also less. You get to less the provision for bad debt. You understand, eh? That provision for bad debt, you remember it, that increase, it was an increase in the provision for bad debt, right? Yes, you should subtract it from the receivables, okay? If it was a reduction, by the way, if it was a reduction in the trade receivables, you were going to add it here, okay? The provision for bad debt here has been subtracted because it was an increase, so it was leading to a reduction in the money that you expect from the people who owe you. You get it, right? As your doubt increases, then your expectations.
So hold on. When we calculated the provision for bad debt, I think we had found 9,726. So if it was an increase, a reduction, so we could have had added it to 397. That's what you mean.
Okay, check. The recoverable debt, you have got the first recoverable debt, right? You had 9,726, right?
Yes.
That was an increase. It was an increase from what? From 30,000, isn't it? There was that, the one that you found like from the previous period, you add all of them together. You get, yes, you're just adding. Plus that 8,000, yeah.
Okay.
Prepaid stationery, you remove the stationery that has been paid in advance. Prepaid the insurance should be removed. Then, oh, sorry, you are not removing, sorry. What am I saying? Like there are assets, okay? A prepayment is an asset, right? Once you pay in advance, that is an asset for you. There's prepaid the stationery, prepaid the insurance, and the cash. All those are current assets. You add them together, you get this as total current what? Total current asset. You get that, right? When you get that, you have the total assets, and these are your total assets. Then you start with the capital and equity. With capital, you always start with the opening capital. Opening capital is given the trial balance like that. Opening capital is in the trial balance. Then you add the net profit, right? So that's why if you find the wrong net profit, you will find pressure in balancing this. So you add the net profit to the capital. Then you less the what? The drawings. Should you subtract the drawings, you should also you should list the what? The drawings. The drawings and the goods drawn for personal use. Aye. This drawing for 30,000 is for money. Then there is also the withdraw of the goods. Aye. So you withdraw all that, which amounts to 31,000, all of them. You should withdraw that. You subtract that from that sum of the sum of net profit plus the capital. Okay, it is this one. This is the sum of net profit plus capital. You remove that. Okay, you remove this from that so that you get that as the total what? Total capital and equity. Okay, then you have the part for what? For non-current liabilities. Under non-current liabilities, just have the loan. There's just a loan, a long-term loan, of course. Then current liabilities. Current liabilities include the trade payables. The trade payables, the people whom you owe as a business. Bank overdraft, there is a bank overdraft. Accrued rent, that accrued rent, those are liabilities as well. So accrued expenses are liabilities. You add them to what? You add them to expenses. Then again, they also resurface to the what? As current liabilities. Did you get that?
Yeah.
So you record them twice. They accrued the expenses. And once you do the right thing, you have this as total non-current. So you add now total current liabilities plus non-current liability plus equity. It should be equal to total what? Total assets. Okay. The accounting equation that you are following is assets is equal to capital plus what? Liability. You're following, eh? This is the accounting equation. So when you add this part, the last part for capital and equity plus this one for liability, they are equal to what? Total assets, and of which that is true. These figures are tallying. So that's it.